Hi, I'm Ben Laidler, the Global Markets Strategist here at eToro. Welcome to our look back at what happened last week, what's going to happen this week, and also our deep dives into the rise of the retail investor and our look at sector allocations. So last week, markets had a bit of a wobble, sold off earlier in the week before finding their footing and recovering. The weakness really driven by this continued global growth scare. Delta variant cases globally up nearly 40% over the last month or so. But the reassurance coming through from very strong start to second quarter earnings. Also, the European Central Bank coming out saying it's going to keep interest rates lower for even longer. And these forward-looking growth indicators, the purchasing manager indices, which despite some variations around the world, are still telling us that growth is in pretty good shape. But do stay diversified. We're probably going to get some choppiness, some increase in volatility over the summer. Markets have come a very long way very quickly. Market volumes in the summer are always sort of somewhat lower. So just be a little bit careful out there. One of the things we looked at this week was really the rise of the retail investor. We got some data out of the United States looking at equity allocations for US households. They've never been higher. We think this is actually pretty sustainable. Those high levels being driven both by higher markets, but also by more people involved in the markets. And with bond yields this low and going to stay low, with household balance sheets in pretty good shape, and with access to markets as really never easier, we see these trends really as pretty sustainable. But investors do have arguably too much invested in their domestic equity markets. This is somewhat understandable, given you're going to be more familiar with those types of stocks, and there are some extra risks and complications to investing internationally. But this having too big of a sort of home market bias does reduce your country and sector diversification. At a time when that diversification has really never been cheaper or easier. You could look at sort of global equity ETFs like ACWI or developed market ETFs like EFA. We've also looked at our sort of sector allocations and preferences. Underneath the hood of this sort of remorseless equity rally, there have been some pretty big changes within sectors. Our sort of favorites right now are the so-called cyclicals, these sectors that are most sensitive and benefit most from this GDP rebound that we see continuing to come through. So sectors like industrials, financials, and commodities. But tech really remains, I think, the foundation for most portfolios over the long term. We're still seeing very good growth numbers. We have very high and sustainable margins and real sort of fortress balance sheets, which allow these companies to increasingly buy back shares and pay dividends. And then just finally, the so-called defensives, things like utilities, consumer staples, which are a lot less leveraged to the growth rebound. They're on the radar screen, but I think for further on in the economic cycle when growth really begins to slow down. So what are we watching for next week? I think two things. One, it's big tech earnings week. So Facebook, Apple, Amazon, Google, Microsoft, all reporting. Together they're nearly 25% of the S&P 500. So really, really key to watch. The good news is I think the growth rates are still going to be very, very strong there. Second thing to watch on Wednesday, you've got the US Federal Reserve meeting. Markets, I think, are going to be following any commentary they make, both on the growth outlook and also inflation, very, very closely. And we may see some volatility on the back of that, just given how much bond yields have really collapsed over the last couple of months. So that's it from me. Please subscribe to the channel if you haven't done already. Trade safe and look forward to talking soon. Bye-bye.